There's often a saying in trading and investing that says follow the money and not your opinions. Today we'll take a look at why Wall Street is doing something rather sneaky that might have most retailers like you and I caught off guard. Also, what's going on from the short, medium and long-term perspective. We'll look at the bull market checklist and what caution signs we might need to be watching on the horizon. Join us as we cover stocks, commodities and cryptos together. It's going to be a great one. Well, welcome back everybody to The Daily Show. My name's Tom and today we're discussing macro, lead indicators and the hottest charts we all need to be watching. If it's your first time here, remember to subscribe and smash that like button if you love markets like we do. Let's go through semiconductors. They were down and Tesla showed some signs of life at the main key level that we've been liking for a little while. It was that 1 month beta test of the FSD that you get now that had everyone excited. But I think it's more than that. It's probably options, and we'll get into that a little bit later on. Let's now talk rotation. It was absolutely a trapped session, and this is because of the 0DTE options this week. They've got the market constrained between two key levels, a put support and a call resistance. But really, it's rotation that's been the big story. And that's been the last couple of weeks now. And of course, if you've been a watcher of this channel, you'd be well aware of it. Gold, metals and materials, and energy sectors have been improving. And most people are not discussing these market sectors a lot. But as it turns out, Goldman Sachs have now unveiled that they've been pretty overweight in a few of these zones. Specifically, the energy sector, which only makes up 4% of the S&P nowadays, has done 11% year to date, and a lot of this has been in recent times, as you can see here. Now, this could mean that we're in the mid-cycle rotational switch for markets, which tends to bring the materials, the energy sector, the financials, and sometimes even the real estate sector, which at the moment is getting absolutely brutalized. Of course, price action will be key, but the biggest flows remain still in communication services, at least for now. Rotation is improving. So could the technical analysis have shown us this? Well, the short answer is yes, and we've been able to see price action giving us these particular orders already for quite some time. But did you know that the members above the rising 50-day SMA, energy now has 96% of stocks improving? In fact, information technology is only at 59, showing some rotations coming out of that, and materials is still on the improve along with industrials and financials. It's great to be able to see this, and it's a fantastic chart here to really save to your bookmarks. Let's go over the last 100-day rally because it's become quite broad in recent times as we've seen an improvement throughout the other sectors. It starts off with those gamma stocks, usually in this case the AI stocks and specifically NVIDIA driving everything, but now it's gone to the broader market. And the current rally is stronger and broader than the average 100-day rally from a bottom, at least at this point. And that really is showing overall some bullish signs. In fact, in terms of a bull market behavior checklist, it's really hitting 8 of the main checklists over here. Again, this is a pretty good one. We're seeing the advanced decline line rising. And of course, we're also seeing things like new highs to new lows improving, long-term risk off, risk on indicators improving, and most stocks above their 200 daily trend. There's a few other things that we can discuss, but this is the main stuff that's happening in the markets right now. Overall, liquidity has also been improving, which is definitely something that helps. And as we know, liquidity is key to these markets, along with easing financial conditions. This has a lot to do with building confidence back into the markets. And you can see here, easing financial conditions tend to be supportive of a rebound in the activity data. So far, it does look like the Goldman Sachs easing financial conditions is absolutely skyrocketing up, which is of course very strong for the bulls and everybody that's liking these markets. So let's now take a look at the S&P 500 in some detail. Now, it's been a pretty strong market recently, and the advanced decline line is something that you might want to put on your charts. Basically, this has been showing improvement across the board, and if this starts to decline and the markets are going sideways, it can tell us that we're in a distribution circle. That certainly is not what's happening at this point. The daily timeframes, though, have been showing some weird wins to the bears. 1, 2, 3, and 4 days now for the bears. And although it's not much move due to the 0DTEs keeping the market fairly trapped, it has shown that there's been a little bit of selling at these tops. When we go into the 5-minute charts, you'll notice that the last 24 hours was really just won by the bears overall. The market opened up and then it just drifted down over the session, ending up at the critical 5,200 level, which we'll watch in a moment. So what levels though from a technical base are we looking at the most? 51.75 and 51.80 remains the key big buy zone. The resistance of 52.50 remains where we could be switching into a positive gamma level and pushing that 5300. And really a lot of this comes down to the zero DTEs. So let's take a look together, and really we're not at those bear levels yet of 50.90 or 50.50 yet. So where are the options? Well, as we mentioned before, it's a positive gamma environment, and this means that at this stage, if we go through things like 52.50 and we break through those levels, it needs to be positively hedged, which is basically going to push the markets up. So there's some gravitation towards that 5,300 level, which is now the biggest strike on the markets. But in recent times, there has been a little bit of an improvement in the number of puts starting to come into this market. And let me have a look and show you from this week's perspective. Take a look at these puts here on both the 27th expiration and the 28th. Huge amounts of puts sitting at around that 5,200 zone. And this is kind of showing you why the market closed exactly where it did over the last 24 hours. We're stuck between the 5210, 5200 level and the 5250. Now, it's probably better for Wall Street to leave it in between these lines. But if we do see a break to the downside, I think we'd go pretty quickly to 51.75. And if we see a break to the upside, then there's a good chance that we'll be probably making our way towards the 5,300 level. Both of these zones are very, very important. And it gets even more puts when you take a look at the 28th. So clearly there's a few people starting to hedge off and saying, you know what, I think there's going to be a sell into the shorter week this week, as we do have core PCE news coming out on a day of illiquidity. Some people are certainly betting on that weakness. But until we break through either level, it's going to be a guess. So remember to mark up those zones and have them on their charts. Let's now take a look at S&P 500 election years versus 2024. It's a great chart here, and it shows us that we're most correlated right now with 2012 and 1976. Now, you could take this with a grain of salt, but in both cases of those periods, we actually saw pullbacks that tended to happen kind of maybe mid to late April into May. Now, if we see price action that really details that that is what's happening, it could be the correction that a lot of people are looking for in markets, which is between like a 5 and 10% move on the downside. Are we due that? Yeah, in some ways we are, but these are the most correlated markets. And in all cases, just remember this, those were up over the next 6 months, which is what the data suggests is more than likely happening right now. Goldman Sachs tends to agree with this data as well. They've actually come out, and I posted this over on our X account if you want to follow it, that they believe that the market is not pricing in the probabilities of major moves. In fact, they say the market's only pricing in a 5% up move, a chance of a 5% up move at about 6% probability, and they think it's more like 25% probability. And they also think that the probability of a down move, while the options are pricing in around a 10%, Goldman Sachs thinks it's 24%. So basically, Goldman thinks vol is coming, and they're really betting on this. Now, you might say, well, Goldman Sachs, they're always wrong or whatever else. They're actually pretty correct on that one in recent times when they've been releasing that data. So it could be on the horizon. And some other reasons why is because no one thinks it's coming. Take a look here at the S&P 500 6-month implied vol spreads. Wow, that's low. And it's the same here on the Russell 2000. No one is hedging. It's primed for that time, but it's been primed for a while. And most options traders would be looking at this really for the last kind of couple of months and saying, surely there's got to be a sell-off coming. Not yet, but again, if the price action shows you, and the big key levels will be the ones we looked at before, including the 20-day moving average, that's what we're going to be watching. So, continue to be a buyer, be a bull if you wish to in markets, but just keep on the lookout that we are in a session now where Goldman Sachs and others are starting to potentially look towards that downward side, at least in terms of their notes. 67 days is the average for a correction period. We're well over 90 into 100 range now. And as we can see here, JP Morgan thinks that we're in crazy momentum on the 99.8th percentile. Some other stats that are interesting around this are, of course, the 100 days without a 2% pullback from close. And in all of those scenarios, they went into pullbacks in time, which were sideways markets initially, or even some bigger corrective moves. So a lot of the data is starting to suggest that it's due. It could be coming. Here's Wayne's data saying that this week is really only a 3 up, 10 down overall in similar circumstances. It's kind of showing you that, yeah, it's probably due in the markets. Watch the price action though, because unless that happens, It's all just guessing, and really you don't want to be guessing. You want to be following and reacting to the overall evidence on the charts. Here we have the S&P 500 index returns in similar situations that we've been right now, which is a 5-month win streak. And you might think, well, that means that everything's going to go bad. Funnily enough, over the next 3 months, it does tend to waver a little bit. You can see there's a few other times where we've had the next 1 to 3 months be a little bit shocking. But overall, it's been up over the next 6 to 12 months with a 93% win rate over the next 12 months. Pretty positive for the buyers in these markets. Weekly flows by client sector size. As we mentioned before, Goldman Sachs has been overweight a couple of markets, but it still remains to be purchased the communication services. The 4-week average is still up a lot, but last week was still up a decent amount. Tech, communication services, they've become the biggest inflows, and healthcare actually shows now a slight decrease in recent weeks. Materials, take a look at this one, certainly flat. We can see in utilities price action, they were starting to buy it. And the energy sector might show that there's not much purchasing, but we know there is because, of course, price action has been detailing that it's coming. Year-to-date performance is a great chart here from the daily chart book, and it shows here that SMCI is really basically making the IWM do well. If you take MSTR and SMCI together and you then whip them out of the IWM, the Russell 2000, the Russell 2000 would only be up 2.67% for this year. So yeah, it's not a very broad market in the Russell 2K yet. That could change if we get through some key levels. Prime US net trading flow, interesting chart here showing some cyclicals improving here and defensives overall improving. Will that continue? Well, we'll find out. This is just one, of course, piece of data. Are we in a bull trend? Well, of course, the data suggests we are, and generally speaking, they last quite a lot longer. And this is the most overlaid previous super bull cycles. Where are we now? Around here. Are we due some type of sidewaysing action? It's potential. Most people are super FOMO on these markets, but that doesn't mean it's over. Long-term averages would have most people saying absolutely buy and hodl for now. Again, here's 1974 and 1942 overlaid, and you'll notice that the market has in general been a little bit more bullish than it was in these other periods. Again, this is where we saw pullbacks in time and slight corrective moves in markets. Bloomberg's US 2024 CPI year-on-year consensus forecast is increasing. So what this is showing us that inflation is back according to the forecast. And here you can see it again for the May expectations, which is now sitting well above 3.2%. What this must have people thinking about is whether it's going to be that kind of sell the fact when this data comes out, or whether it's just going to continue to be a rotation into energy and other markets. One thing's for sure, there's a lot of opportunity in the areas right now, including, as we've spoken about, Chinese stocks. You can see here that the news stories are starting to kind of show that there could be a base. The other thing that's happening as well is that China is one of the only markets really trading well underneath its overall historical median. When we take a look at China, excluding state-owned enterprises, it usually trades at around a 21.3 PE, and the current level here, as you can see, is 16.2, 13.8 versus 17.7. So it's cheap on a lot of areas, and I think the AI play here is still quite interesting, and we've been talking about that now for about a month and a half. NASDAQ versus CTAs. Have we seen a decrease? A minuscule one, still no new lower low. A new lower low would certainly be a negative sign, as we'd see these systematic funds basically pulling out of the market. Here's the S&P 500 versus CTAs, which is just dipped for the first time in a while. Now, is it enough to look at it? No, not yet, but we will be, of course, tracking it. CTAs can sometimes preempt the rest of the market. Let's do a quick deep dive into Tesla now. So Tesla bounced off that important 165 zone. This level is really, really big, and they also brought out some interesting information, obviously announcing that they were going to do the 1 month kind of free trial for the FSD, and that had the markets excited in this morning of the session, and it broke through this most traded zone here of 182. Now, that's a good sign. Unfortunately, it couldn't hold it, and the sellers sold straight back off, but this again shows me signs of a basing. So for longer term investors, they might be liking this, well, medium term investors, probably in the next couple of months, they might be liking this level as a hold zone. We've already detailed several times that someone has purchased this level in a big way. And I think a lot of that has to do with options. Let's take a look at the options market here. Now, we often talk about put walls and call walls. And in specific times, we also talk about positive gamma and negative gamma. In this case, most people seem to have gone short around 170. Now, if it breaks underneath 170 and closes, especially if those dates are close to the current strike, then it may need to be hedged. But it's a little bit different to the zero DTEs we see on the S&P 500. In this case, 170 is acting like a level of demand. So basically, as the market comes back down to 170, for now, this level is holding. And that could mean that, again, it's putting a bit of a flaw in the market overall. 170 is a very strong level for Tesla. And for now, that's really what we're looking at. You can also see some calls coming in here. So if we switch into the more positive gamma environment and start to actually strike off a lot of calls on the shorter dates, it could force that squeeze that so many people have gotten used to on this stock. Very interesting here for Tesla. 170, very big base along with the technical levels. When we look at options, it was a very slow day. So I won't go through this too much. 58% calls, retail traders trading 30% of the overall single stocks. And you can see here the most popular overall. It's just quite a week on the markets, and a lot of this is being shown in the zero DTEs. When we go to the main charts, the VIX is now coming back down to that all-important 12 level. I often consider this the calm before the potential storm. We know that VIX has been boring. If we get above 16, set an alert for that. If that happens, it's on for the bears. And at this point, it's just in a normalized level. This means that single stocks and sectors are the best things for us to be looking at right now in markets. And I think it's pretty key to be watching. S&P 500 versus central bank liquidity. Central bank liquidity continues to dip here, guys. And that's weird. Certainly something we are watching. If price action comes down, along with a few other signs, maybe bonds, could be showing us that there's negativity in the markets. And that is kind of what happened over the last 24 hours. We saw bonds such as high yields dropping here, and that was interesting. We also saw, in general, bonds versus some of our other indicators dropping quite substantially, but they remain in the coiled location. Remember, if bonds drop through these coils and the stock market's going up, I would not trust the stock market at that point. Bonds generally predict the next move, and at this stage, they're just floating around. Here's another one of our lines, which kind of tracks, high yields and options in general with bonds. And you can see here that it's picked up, but no noticeable increase over the last 24 hours. If it did, we'd report on it. US 2-year, we're trapped within a range, so we're right on that kind of trap level. US dollar has been sitting on its resistance, so not too much to report back from here. A break and close on the weekly will have major implications though. So of course the US dollar is really going up mostly because other central banks are cutting rates while the US hasn't done it yet. So they might be doing it at a faster rate. And for oil-based traders, it's back at that most traded area. So for bulls, they need to pick it up right now at around the same point. Then overall, this is a zone that we want to be looking at. So yeah, this is a key zone for the markets. And for a bull, it's going to be right now or never for UK Brent and US oil. Semiconductors versus SPY. What's going on here? Well, it's been actually still kind of weak, and this has shown that rotation has been through. It's always great to play some of these charts and look at them because semiconductors versus SPY, most of the time semiconductors are going to kick SPY's ass. Sometimes it's going to have weakness, and it's a pullback in time or a pullback sideways. We saw that a lot of 2023, then it broke out late last year when we went into that new rally. And in general, semiconductors will outperform, but sometimes they need to take a breather. And this is the type of chart that shows a breather's coming. Gold back at the first level of a bull level. Again, day traders will be watching this one very closely to see whether they can activate bull trades. We did see some nice signs here of bullish action. Overall, it is still in that flag of the longer term. And yeah, it's right at that bull level for day traders. Let's look at NVIDIA now. NVIDIA dropped off after making to the 960. Seems like the 1000 is a little bit tough for this. Remember, this is most likely a split candidate in the future. So there's a great split trade here at some point. But as most of you would like, I'm sure you want cheaper prices. 860 being the main technical support on this particular chart. Semiconductors such as SMCI were kind of similar. They actually bounced to an area where I could see bears having a go at it. I personally don't like shorting semiconductors. It's too hard. It's a very, very, very bullish market. But if you were a bear, I could see why you'd like the 1100 with stops above the 1200. And there's a possible chance you could get it back to 800 or even the 700 target. after seeing a candle like this, to me, it showed us that we were going sideways for a while. And that so far, it's been kind of like that up, down, all around on a very, very wild move. AMD managed to hold okay for the session, only down 0.43% on the day. And you can see here, it's holding itself around the key zone. So this is a fairly big level for AMD. It's a very important most traded level. It's also a VWAP zone. There's a lot to like about it after it's been super negative, but we do want it through that 2-hour 20 moving average, and it still can't get through there. Let's get a 183 break close on that to really show momentum's coming back into the AMD trade. Oz 200 remains very bullish as we go through these indices here, and it's looking pretty good thanks to the inflation-based trades. Could be 8,000 next for Aussie 200, and with the Australians out there finally seeing this market improve. It's been very bad, similar to the FTSE, against the US for quite some time, so hopefully it keeps going better. Chinese market certainly holding itself, till 2 steps up, 1 step back, looking for a 17,000 breakout. Once that happens, momentum traders will come back in, and we could have a fairly quick move to the 18,000 level. US 2K, not a great daily close here, a little bit negative on this chart. Looking at buyers around 2040, 2050 for potential longs. And of course, the weekly close is all important on this chart. We'll come back to see whether the sleeping dragon has woken up, because of course, that's a market that I am looking at. NASDAQ, let's take a look at this one. It's still dull, still floating around, still multiple days of overall bears winning. However, they've only barely been winning. It could be coiling for a massive breakout. So remember, still a positive gamma environment. The S&P 500, though, is the key for this. If S&P 500 comes down to support and finds buyers, then the NASDAQ would also be maybe a proxy buy if you wish to do it that way. Let's now take a look at not Buffett's fund. I was looking at value before because there are a lot of mid caps here doing better, and we'll go through that in our next video. But Bitcoin has broken through the 70K, and at the moment, the bulls are in full control. We pretty much nailed this one together. We got the perfect level here. We obviously got the perfect first pullback. But if the markets do, for whatever reason, get back down to this level, I don't like it anymore. It's already done what it's meant to do. If it did get back down there, 5150, 5200 would be the next major zone. News for the week ahead. There's quite a lot going through, guys, but it's really mostly about core PCE, which is one of the Fed's metrics, and of course, Powell coming out right after that at 11:30 New York time. There's a lot going on in markets. Make sure to stay tuned to The Daily Show. If you enjoyed today's video, please subscribe, and we'll see you in the next one. Bye for now.